Hi, Kurt Jackson, Retirement Income Strategist with KJ Financial here with this week's Your Money Matters. We're going to kind of go through an article that I found that if you follow any of the stuff that I talk about, I'm pretty anti-Wall Street, anti-traditional financial planning. It's what my research has shown me since 2003 when I was in the mortgage industry and I started to research. And then keep in mind, when I started my research, I didn't have a dog in that fight. I didn't care how it went. I was just trying to find better ways to help my clients, to add value to that relationship I had with my mortgage clients. What I found really ticked me off, and I keep finally finding some more stuff in the mainstream media that backs up what I've been saying for, 12 years now. And this is from Bloomberg Market Watch, and it says, opinion, Wall Street experts have missed every stock market crash in 20 years. And basically it says, this is the 10 things that Wall Street, their alleged experts, they won't tell you but should. Number one is our investment forecasts are bogus. Basically, they tell you that historically they have average returns of 9% a year, but it's based on faulty math. I've gone over that before. They use historic data, but they kind of misuse that data. Number two, this is about all of the experts. We only agree because we have to. It says every expert seems to parrot the same cheerful things as every other, but if you think that's because they all independently reach the same conclusions, you're dreaming. They have to agree. Professionally, it's far better to be wrong in mass than right independently. And legally, one of the ways to avoid being sued is just to do what all your competitors are doing, no matter how wise or foolish it may be. Your Honor, everyone in the industry was doing the same thing and is an actual defense, even if it bankrupted your clients. That should bring you a lot of faith, shouldn't it? We don't know anything about history is number three. Wall Street experts like to cite historical data to validate their strategies and analysis. The problem is they actually know little about financial history and understand it even less. Most of their historical data comes from like the past few decades, and that's an unprecedented era. See, back in 1983 is when 401ks really kicked in. So you had a whole bunch of people that never invested in the stock market. Now we're investing in the stock market. And you saw it basically meteorically rise until 1999. And then 2000 hit. So we had a drop 2000 to 2002. Went back up. Came in 2007 or 2009. We saw it drop again. And we're on that upward trek again. But now we're starting to see some chinks in that armor. So historically, a few decades is really of data is worth nothing. It's a mere snapshot in time. Number four is we've missed every crash. It's worth remembering in the last 20 years, the U.S. stock market has fallen twice by about a half, and on both occasions, most Wall Street experts were taken completely by surprise. They also failed to predict the housing bust. In fact, most of them indeed cited history to say that couldn't happen. I was in the middle of that. I remember people saying all of that, though there's no way that housing could crash. And we didn't see it so much in Kansas City, but I was seeing it when I was talking to people from around the country. I had no idea it would be as big as what it was, but I did see that coming. I'm not going to lie to you and tell you I knew right when it was coming. I just knew it eventually was going to have to happen. A majority of economists polled in early 2008 failed to predict the biggest recession in 70 years, even though it had already begun. All the experts at the International Monetary Fund completely failed to predict a financial crisis as well. And since 2011, most Wall Street experts have missed the crashes we've had in emerging market stocks and commodities as well. Number five, and this is really key. I think that people don't realize this, and we kind of live in that Pollyanna world that we think everybody's doing what's right for us. And that number five is your wealth is not our number one priority. Wall Street's number one priority is not to protect your wealth; it's to protect theirs, and you need to realize that. And think about 401ks everywhere. We all have money in mutual funds, and in fact, I've looked at clients' the list of options that they have inside their 401ks, 403bs, 457 plans. Very few of them have any kind of safe money options. So even if you were watching and wanted to get out as the market's going down, you don't really have any place to go that's safe. So it's crazy. Number six is your balanced portfolio can fail. We have that mix of stocks and bonds. It's conventional wisdom that that when you have that balanced portfolios, if stocks are going up, if bonds are going down, then stocks are going up, and if stocks are going down, bonds are going up, then stocks are. If stocks are going down, bonds are going up, and that inverse relationship happens some of the time, but not all the time. Number 7 is there's no money on the sidelines to push the market higher. They're fond of saying there's so much money on the sidelines. There's really not, they may think there's money on the sidelines, but those people are either they're back and forth trading with that money, or it's somewhere else and they're not looking to put it into the market. The best investments are the ones that they're not going to tell you about. The biggest conspiracy on Wall Street is the one that's hiding in plain sight. The best long-term investments must, by definition, be those that are cheapest in relation to their fundamental worth. That was true, for example, of emerging markets in the late 90s after the Asian crisis, the old economy, non-dot-coms in 1999, during the internet bubble, dot-coms in 2003 after that crash, and the housing 2010 to 2012 after that crash too. But guess what? Those are exactly the investments that Wall Street can never and will never recommend, because the professional risk to them is too great. All right. If they recommend you buy today's most hated assets and you make a fortune, they don't get the upside. But if they recommend you buy today's most hated assets and those assets fall further, they'll get fired and you'll probably sue them. So instead, they're going to recommend you invest in things that everyone else likes. Make what of it you will, but right now everyone is running away from emerging market stocks and currencies and anything to do with commodities because they've been going down. Warren Buffett always talks about when you buy when there's blood in the streets. Well, okay, but what if that's still at risk, right? What if there were options? And then we talk about our options in almost all the content marketing I do. We're always talking about options. If you'd like to know more specifically about those options, just reach out to me and let's have a conversation. Let's see. The better the market, the worse the outlook. Have you been watching the market go up, up and up and up? Are you afraid of missing out on further gains? Do you want to put your money back to work? Wall Street loves you. Here's what's funny. When you're down, they tell you, oh, you haven't lost unless you sell. If you sell, you lock in those losses. How many times have you ever heard your financial person, when you're up, say, well, no, you're up, but you really aren't up unless you sell and lock in those gains? Do you ever hear them say that? I don't think I've ever heard one say that. But it's true. If you really want to lock in those gains when you have them, you've got to sell and get out, right? So really what it is if you're up in your account, you're up. If you're down in your account, you're down. All right, so don't let them. And then I love the stocks are cheap. You got to keep buying. Dollar cost averaging. Well, that may work, that may not. But I guess my point is what I've found in the alternative retirement strategies is there are options that are much better, and the real math will tell the story on that. Now, if the market's going to go up 20% a year for the rest of creation, then it's not. But if you think that that's what's going to happen in the market, then the type of stuff that we do isn't for you. And quite frankly, I would say you're nuts if you think that's going to happen. All right, the last one is another crisis is just around the corner. If you missed the last big buying opportunity, don't panic. Another one's probably going to come along shortly. What if you could have your money somewhere that when the market went down, you didn't lose, but yet it was sitting there ready to go when the market has that opportunity when it's coming out of going down? What if even if you couldn't get all of those gains, but you could get a good portion of them or most of them? I've seen some different data. I can't remember the exact numbers, but it was if you could get, I think it was, oh shoot, you know what? I'm not even going to say it. I need to find that data again, that research again, and maybe start using that on how much if you just grab a certain percentage of the gains in the market and never lost, how much better you would be doing than if you stayed in the market the whole time. And that just doesn't even take into account tax advantages. We're taught to put our money in our 401k because we're deferring taxes. Aren't we putting a little bit of money? Aren't we deferring taxes? Supposed tax deduction, but you're just deferring those taxes on a little bit of money to grow it into a big amount of money to pay taxes on all of that money. Even if it's at a lower tax rate, which it probably won't be, does that sound like a smart thing? So over a 40-year work life, I'm deferring taxes on my $5,000 contribution every year, right? But now I'm going to pull $40,000 in income out in retirement for 15, 20, 25, 30, 35 years, depending, life expectancy for someone that's 65 today, for a male is 86.6, for a female is 88.8. That's 21 and 23 years plus. That means half the people will live past that. Excuse me. So you're telling me that deferring taxes at a rate for 40 years on a little bit of money is smart, and then paying taxes on a lot higher amount of money at a rate you don't know for a period of time that you don't know is smart? What if also that where they told you to put your money also made you unnecessarily pay taxes on Social Security benefits? That might be another $2,000 to $6,000 or $7,000 a year in additional unnecessary taxes. There's the whole. I've come to the conclusion that the entire traditional financial planning model is severely flawed to the advantage of Wall Street and the government, and to your disadvantage. If I can just the more people I can get to at least open their mind to that concept and have a conversation about it, I think the better off we will all be. It's funny, is people when they talk to me about these things, this is why isn't everyone using these alternative strategies? And I thought about that for a long time, and really, here's what I say now to people is, I understand what you think. When you look at it, you're right. You think everybody should be doing it. So really, what's happened is everyone who really understands it is doing it, if that makes any sense. So I mean, that's kind of the conclusion that I've come to. I've had people come to me that'll sit down and talk to me for a little while, but their mind's closed. They won't even open up to the fact that there's alternatives. I've done that with certified financial planners who are supposed to be the top echelon of people that are helping you out, who won't even consider alternatives to what they've been taught their entire lives. That doesn't make sense to me. Doesn't that mean that they're really not acting in your best interest if they won't even open their minds to other alternatives? I continue to do updated research to see if anything changes anywhere else that's better than what I do. We've altered what we've done over the years because things improve. When we do something with someone, it's the best there was at that point in time, but we're constantly looking to see if new things can help us do more things. And then when we come back and revisit with those folks and we can change their strategy, if it makes sense to, we'll change their strategy. So just some interesting information, and it's nice to see that some of the mainstream media is out there talking about the same similar things to what we've been talking about for 12 years now. So if you have any questions or you want to have a conversation about, look, I'm not a high pressure guy. We'll talk about the things if it makes sense to you, and you want to look at going a little further and see what it looks like specifically for you. We can work all that out. So thanks for tuning in. If you find this information helpful, please share it with your friends, family, anyone you care about, coworkers, and be sure to make sure you check out my other stuff. Right now, at this point in time, we're just rolling out our In Your 50s. I think there's an 11-part series on that. Next, we'll do 60s. There's probably going to be 12 or 13 in that. And then we'll drop back and do In Your 40s and then In Your 30s. And really, the In Your 30s and 20s is pretty similar on the information, on the data that you get. But that's kind of how we're rolling it out. So over the next several weeks through the rest of the year, that's what we're going to be doing. So make sure you check us out on LinkedIn and Facebook, Twitter, all those. We're putting all that content information out there. And if you're not getting it, just give me a holler and I'll make sure that when we post anything new, if you're not on any of those, I'll email you a link to the information. So thanks for tuning in, everybody. Have a great week. Talk to you next week.